I'm happy to buy Apple for $120. So I'm going to agree to buy Apple for $120. And let's say for a month, the market pays me $4 a share. Okay. Now, $4 a share on $120 stock, that's almost a 3.5% return for a month. And what is my worst case scenario? I own Apple for $120. Now remember, I keep the $4 no matter what happens. Hey guys, Omar here from Theta Trading. First off, I want to thank you guys for watching this video. I'd like to ask you a favor. If you guys could subscribe, like, and press the bell icon, it would be greatly appreciated. We'd like to keep providing these updates. And in the comment section, if you wouldn't mind writing below, what would you like to see? I've been trading for 23 years. I'm a co-founder of Theta Trading, and we found a really, really good system that works for us. And we're trying to get this out to as many people as possible, the understanding of financial literacy and how it works. So in the comment section, if you guys wouldn't mind commenting below, what topics would you like to hear? Okay, so that would be greatly appreciated. Today's topic we're going to talk about is why sell puts versus buying a stock. Simple concept. I'm going to explain the difference between both, and then the advantages and disadvantages, and why we prefer to sell puts as opposed to buying stocks. Okay, all right, fantastic. So let's look at the traditional way of buying stocks. All right, guys, traditional way of buying stocks is what? Buy low, sell high. Pretty simple, right? But it doesn't quite work that way. All right, so buy low, sell high. People say, oh, buy low, sell high. Well, that is true. However, think about it this way. When the markets go down and you don't have confidence in the stock you're buying, when it goes down, you're not going to feel like buying more. Why? Because you don't know why you bought it in the first place, okay? So that is one of the major problems with just buying and holding a stock. So I'm going to compare and contrast buying a stock versus how we do it here at Theta Trading. We sell puts to buy stocks, okay? So let's talk about the first one, buying stocks. Okay, so traditionally, what do? Buy low, sell high. That means, let's say, for example, today Apple is trading at 120 bucks. Okay, great. Well, I say to myself, I can just buy Apple. Why? Because I've done something called fundamental analysis, fundamental homework. I've reviewed their balance sheets. I have an idea as to what's going on. I have an idea as to how much money they're making. And here at Theta Trading, we also use very anecdotal evidence, right? What do our eyes tell us? Well, our eyes tell us that a lot of people are buying Apple products. Now, I have a 14-year-old daughter, and I asked her a little while ago, I said, hey, out of all your friends, how many are Android and how many are iOS? And she goes, Dad, nobody is Android. And I was like, I was flabbergasted, because people my age, there's a real good mixture between Android and iOS. Okay. Now my daughter's 14, so her age group, around that age group, maybe a little older and definitely a little bit lower, they're all iOS. So that itself is anecdotal evidence. Now, there's a great investor back in the day called Peter Lynch, who worked for Fidelity and the Magellan Fund. Now, he talked about investing in things that you understand and things that you can see with your eyes. That is a great example of something that you can see with your eyes, okay? You can see people are buying and holding Apple. They're buying a lot of Apple products, iPhones, iPads, AirPods. I've got all kinds of stuff here with Apple. And I see everyone in my family has a bunch of Apple stuff. So what does that tell us? Well, once we've gone through the financial statements and we can look around, I'm just talking about simple visually looking around. You see, ask questions, ask, younger generation, hey, are you guys using iOS? Are you guys using Android? And that'll give you a good idea as to how this company may perform in the future. So the traditional way of getting back to buying stocks is I can say to myself, well, hey, now I've done my fundamental homework. I've realized that I want to buy Apple. Why? Because the numbers make sense. I've gone over the financial statements. I know how much money they're making. I know what product line they have. I know how good their management team is. I know how much cash they have. I know how much dividends they have. We go over all this stuff on a regular basis here at Theta. Now, once I've determined that I can just say to myself, well, Apple's trading at $120 a share. And I can go to myself, you know what, why don't I buy Apple? Because I think Apple will be worth $130 or $140 or $170 a year from now. And that's determined by doing fundamental analysis. But we look around, just looking around, we know so many people are using iOS. And more people, especially the younger generation, are migrating to that platform. That bodes well for their future prospects of that company. Now, the problem with most people is, first of all, they don't know why they're buying the stock. They're just buying it, and they're thinking, okay, well, I'm going to throw a bunch of shit against the wall and hopefully something sticks, right? That's the most traditional way of investing, where people have no idea what they're doing. They just like, I'll buy 20 stocks. My buddy told me about some weed stock. Some other person told me about this. I heard about this on CNBC, and that's what they do. Again, just throw a bunch of shit to the wall and hopefully something sticks. That is the most common way of investing, but that is obviously wrought with all kinds of errors and issues. So what we prefer to do here at Theta is we prefer to do our fundamental analysis. How good is this company financially? How solid are they financially? So we've determined that Apple is very sound financially. Okay. Again, like I said, we think the stock will be much higher in price. So I have two different ways. I'm going to buy the stock today at 120, and I'm going to exit it, 130, 140, 170, or I could just hold it indefinitely because I think the company will be worth a lot more down the road. Okay. That is the traditional way of buying stocks. Now, the problem with the traditional way of buying stocks is that when the markets are going down, people's mentality or their psychology won't allow them to buy stock because they're like, uh-oh, market's going down. Let me hang on. It's going to go lower. This is a traditional error that people make. They assume the markets are going to keep going on. They're unable to pull the trigger when the market's down. We here at Theta are contrarians, right? When others are fearful, we are greedy. And when others are greedy, we are fearful. That goes back to the Warren Buffett quote. So when the markets are going down, we are more inclined to buy a stock and hold it. So that's one way of doing things, okay? Buy that stock. But again, if you haven't done your fundamental homework and you don't know how good this company is, you won't know what a good entry price would be, right? Because you're like, oh, I don't know. Is it worth 120 a share? Is it worth 110? Is it worth 105? I don't know, right? Now, when you've done your homework, you have a good idea of what it's worth and what you think it will be worth in the future. So without fundamental analysis, meaning analyzing how solid this company is financially, it's difficult to make an investment decision. Simple as that. And that's why a lot of people screw up in the stock market, because they don't know what they're buying or why they're buying it. So when it goes down, they get panicked and they sell out at a loss. And that's not a good place to be. So that's one way of buying stocks. That's the traditional way. Buy and hold. Hopefully you've done your fundamental analysis. If you haven't, when the stock market takes a shit, you're going to be terrified. And that's not a good place to be. You're going to be tossing and turning. What should I do? Reading newspaper articles online articles and saying, oh, what should I do? I'm panicked. I'm worried. Should I sell? That's not investing. That's just gambling and hoping. Now, there's a legitimate case to be said, okay, I've done my homework on this company. I believe it's going to be worth a lot more. I'm going to buy it. I'm going to hold it because I think it's worth it. That's a legitimate investment strategy and buy and hold strategy. That's one way of doing it. All right, let's talk about what we do here at Theta. We sell puts or write puts, okay, in order to buy a stock. Let me give you an example. We'll go back to that same example of Apple. Apple's trading $120 a share, and I have two ways of looking at this, okay, two ways. I can say, one, I'm going to buy Apple, and I'm going to hold it and wait for it to go up. Okay, I'm happy to buy it for 120, and I'm going to wait for it to go up. What we do here at Theta is, in fact, we don't buy stock. We sell puts to buy the stock. Okay, so let me describe that to you. Did you know that, for example, if Apple's trading at $120, I can simply come in there and say, you know what? I'm happy to buy Apple for 120. So I enter a contract. That is a contract, and that's called selling a put. And I say to the market, hey, market, I'm happy to buy Apple for $120. So I'm going to agree to buy Apple for $120. And let's say for a month, the market pays me $4 a share, okay? Now, $4 a share on $120 stock, that's almost a 3.5% return for a month, right? And what is my worst case scenario? I own Apple for $120. Now, remember, I keep the $4 no matter what happens. So let me reiterate that again, okay? One way is to buy and hold a stock like Apple, okay? The other way is to sell a put. The reason we prefer to sell a put is because it lowers our cost. It allows us to get a discount on a stock. If you were unaware that you could get a discount simply for agreeing to buy a high-quality company like Apple, not actually buying it, simply for agreeing to buy it. And again, that's not meant to be a stock recommendation anyway. But for us, if we believe Apple's a high-quality company, we have two ways of looking at this. One is we can say we can buy it at whatever price it is today. Or B, which is what we prefer to do, is we can say, you know what? Let's just agree to buy it at or below its current price of 120. I can agree to buy it for 120, 119, 115, 110, that's my choice. And again, I will be compensated accordingly. So what that allows you to do, let's go back to that Apple example here. If Apple's trading at $120 and I agree to buy it for $120 and I'm getting paid over 3% for the month, okay? Well, 3% for a month, that is a pretty good return. You analyze that on a non-compounded basis, that's 36%. That is a very healthy return. And what's my worst case scenario? As long as I'm not leveraging myself or using too much margin or any margin, what is my worst case scenario? I own Apple. That's it. That's my worst case scenario. More than happy to take on that risk. Okay, and I'm being compensated very well. And this is the difference between having a sophisticated investment strategy and not quite understand the markets. Okay, so again, just to reiterate, there's two different ways of buying a stock. The traditional, which I think 99% of the population does, is they just buy a stock. The more sophisticated investors at least know why they're buying a stock. Dumb money has no fucking idea why they're buying a stock. No clue. They're just like, let me just throw this shit against the wall, and hopefully some of it sticks. And when you have a bull market, you tend to look like a genius, even though you had no clue what you're doing. And that's what's happened a lot recently. Post-pandemic, a lot of stocks have gone up, and a lot of people think they know the stock market. They don't. They just, everything happens to be going up, and then you're starting to look like a genius. Now, again, we prefer the other methodology. We do our homework on the company. We know what it's worth today. We have an idea. No one's ever going to know exactly what it's worth because a lot of that is subjective. Then we go in there, and instead of buying the stock, we simply agree to buy it. And for agreeing to buy it, we get compensated. And if things don't go our way, which happens, right? What's our worst case scenario? Well, we own Apple, right? Now, that is a level of risk we are more than happy to take on because we would have bought Apple anyways, right? Now, this is the difference, again, between buying and holding a stock and learning how to acquire that same stock cheaper and being compensated a lot of money for it over time, okay? To me, when I write a put or sell a put, those words are synonymous. They mean the same thing. I'm accomplishing two things, in my opinion. I'm lowering my risk, okay, because I'm saying, well, okay, my worst case scenario is I'm going to buy Apple at a discount versus I don't get the discount when I'm buying and holding. Second is that I get compensated. Okay, so not only do I agree to buy it for a discount, I also make money. I get paid. Someone is going to pay me a bunch of money, right, simply for agreeing to buy Apple at a discount. Now, to me, that's a no-brainer. Imagine you could do this with a house. So I'm going to give you an analogy on a house on what a naked put or selling a put means. Okay, imagine you go to a homeowner and you say, "Hey, homeowner, I see that your property is listed for $500,000. Great." And you go to Mr. or Mrs. Homeowner and you say, "Hey, you know what? I'll take that property off your hand for $490,000 in the next 30 days. But because I'm agreeing to take that off you for $490,000, you're going to pay me $10,000 in addition to that." Now, to me, that's a no-brainer deal because why? You would buy that house anyways for $500,000. So to be able to buy it for $490,000 is a nice little discount to have, right? You get a very nice discount on that $490,000. So not only are you getting it as a worst case scenario, you get a $10,000 discount on the stock, you are also getting a $10,000 known as a premium. Now, you can't do this in the real estate market, but did you know that you can do this in the stock market? And when you learn how to do this and take advantage of this information in the stock market, you can create tremendous amounts of wealth over a period of time. This is all about financial literacy, okay? All right, guys. So that is the two ways of buying a stock, okay? Now, the one caveat I'll say is if you're agreeing to buy a stock and you're writing or selling puts, where it can cause a problem, or not cause a problem, or at least not be as ideal or as efficient, is if I agree to buy Apple for 120 and it happens to take off to 150 in a month, and I only got $4 or $5. Well, I could have had a lot more if I just bought the stock. But if I found that over the many years that I've been trading, when I consistently sell puts, I collect so much in premium that far outweighs any sort of potential risk of a stock taking off on me. So anyways, guys, thank you for joining us today, and we're hopefully looking forward to bringing you a lot more videos. If you guys could comment in the section below what you'd like to see, we would greatly appreciate it. Until next time, we'll see you later. Take care.